If you've been fortunate enough to accumulate the financial means to retire or are well on your way to an early retirement, don't make the mistake of waiting too long to start planning. Once you hit age 50, there are some great opportunities to boost your retirement savings and optimize your cash flow and tax planning before you take that big step of leaving your job for retirement. I'm Nick Augustini, the Chief Investment Officer at Slayton Lewis. In this video, I'm going to walk you through a timeline of age-specific milestones and strategies that you can take at different points throughout your 50s and 60s to set yourself up for success in retirement. Before I dive into the age-specific strategies, I do want to point out that low-income years can be prime opportunities for Roth conversions. A Roth conversion is where you roll money from a pre-tax retirement account to a Roth account. The idea is to accelerate income recognition when you're in a low-income year so you can avoid the tax hit in later years, since distributions from a Roth are not taxable. There is one important thing to note though. If you are not yet 59 and a half, you need to have the cash available to pay this tax liability resulting from the conversion. If you try to withhold money from the rollover to cover the tax liability, you will be hit with a 10% early withdrawal penalty. Now, let's get into the actual timeline of specific ages and strategies that you need to be aware of. When you hit age 50, you can start to make catch-up contributions to qualified retirement accounts. This includes employer-sponsored accounts such as 401ks or 403bs, as well as individual accounts such as traditional and Roth IRAs. In 2024, you can put in an extra $7,500 per year into a 401k on top of the standard IRS max of $23,000. Bringing the total to $30,500 per year. For individual accounts, such as traditional IRAs and Roth IRAs, you can put an additional $1,000 on top of the standard limit of $7,000. Not only does this allow you to shelter more of your income from taxes today, but that money can grow and compound tax-free until you need to draw on it in retirement. Then, when you turn 55, if you are eligible to make HSA contributions, you can now make catch-up contributions to HSAs of up to $1,000 per year. This is on top of the standard contribution limit of $4,150 for individuals or $8,300 for families in 2024. This is really valuable money that can not only reduce your taxes today, but it will grow tax-free and it can be used tax-free for qualified medical expenses. On top of that, another great advantage of HSAs is that it rolls over from year to year and it isn't tied to your employer, so you can hold on to it even if you leave your job. Another strategy that comes into play at age 55 is what's called the Rule of 55. This rule allows you to withdraw money from the 401k at your most recent employer without incurring the 10% early distribution penalty, as long as you worked at this employer until you were at least age 55. Remember, under normal circumstances, you'd have to pay a 10% early withdrawal penalty for pulling money out before age 59 and a half. With this rule, you avoid that penalty. However, be aware that you cannot utilize the Rule of 55 for any money that's been rolled into an IRA or money that's held in a 401k sponsored by a previous employer that is not your most recent. When you get to age 59 and a half, you can finally tap those retirement accounts without incurring the 10% early distribution penalty at all. Remember, any pre-tax money is still going to be taxed as income upon withdrawal. You're simply avoiding that 10% penalty after 59 and a half. Thanks to the Secure 2.0 Act, starting in 2025, people between the ages of 60 and 63 will now be able to make an additional catch-up contribution to their 401k. So, on top of the normal $7,500 catch-up that anyone over age 50 can contribute, those of you between age 60 and 63 can now put an additional $3,750 into your 401k, bringing that total catch-up amount to $11,250. For anyone who is divorced or widowed, at age 60, you can actually remarry and still be eligible to collect Social Security benefits based on your ex's or late spouse's earnings record. If your spouse is deceased, you can also begin taking Social Security payments at age 60, although the benefit will be reduced pretty significantly. On that topic, age 62 is when everyone else who qualifies for Social Security can file for early retirement benefits. However, the payment that you're entitled to at your full retirement age is going to be reduced pretty significantly, up to 30%, depending on how early you file. On top of that, if you're still working and your income is above certain limits, your benefit will actually be reduced even more. Some people like to start collecting benefits as early as possible, but filing this early is rarely the optimal strategy unless you don't expect to live into your 80s. Now, one year that's frequently overlooked from a planning perspective is age 63. This is the year that Medicare is going to reference to determine what your premiums will be when you enroll down the road at age 65. Now, the reason it looks back 2 years has to do with your premiums being based on your modified AGI, which comes from your tax return. So, let's say you're 64 years old and you plan to take Medicare next year. Well, Medicare doesn't know what your income's going to be next year because you won't be filing your return until the following year. And Medicare doesn't even know what your income's going to be this year because you're not going to file that return until next year. Therefore, your return from last year is all they have to look back on. Now, the reason it's so important to start planning ahead is that the difference in premiums between the lowest and highest income levels is over $400 per month. So this is one of those situations where an extra dollar of income can actually cost you thousands in annual premiums if you're not planning ahead. Our in-house CPA actually just wrote an article about this, which you could check out on our website at the link below. Now, when you hit age 65, you can actually enroll in Medicare. Unless you're still working and covered by a company healthcare plan, you should probably apply during the enrollment period to avoid penalties. This enrollment period starts 3 months before the month of your 65th birthday and ends 3 months after the month of your 65th birthday. There are tons of nuances with Medicare, so I strongly encourage you to begin your research long before this enrollment period actually begins. Depending on the year you were born, your full retirement age to claim Social Security benefits will fall somewhere between age 66 and 67. At this point, you are entitled to your full benefit. However, if you continue to wait past your full retirement age, you will actually get delayed credits every single month equal to about 8% per year. If you have significant assets or you expect to live well into your 80s and beyond, it may actually make sense for you to keep waiting beyond your full retirement age. On top of that, your benefits will continue to grow with a cost of living adjustment each year. One little nuance to note about Social Security: if you are married and plan to claim spousal benefits based on your partner's income record, it likely makes sense for you to file right at your full retirement age, as spousal benefits do not get those delayed credits that I just mentioned. Age 70 is when those delayed credits actually stop accruing. So if you've waited this long, you should file for Social Security benefits at this point. Finally, the last important age to be aware of is 73 if you were born between 1951 and 1959, or age 75 if you were born after 1959. This is when required minimum distributions kick in, or RMDs. RMDs are mandatory distributions you have to take from pre-tax retirement accounts, even if you don't need the money for living expenses. Optimizing your taxes before RMDs kick in is critical, as they can dramatically increase your taxable income, and there's really not a whole lot of planning you can do beyond this point once they begin. Thank you for taking the time to watch this video. If you have any questions or want to discuss any of this in more detail, please feel free to reach out to me at nick@slaytonlewis.com. Thank you.